Hi there, this is Huskins, your Forex mentor. Today I wanted to talk to you about a very important report which comes out at the end of every week. It's called the COT, or the Commitments of Traders Report. Now, the Commitments of Traders Report is released by the CFTC, which documents the changes in positions held in the futures market by three broad market participants: the commercials, the speculators, and the small time traders. Now, who are these commercials? The commercials are the people who actually have the product, going to have the product, or the people who need the product or are going to need the product. They enter into a futures position to offset any price change risks. What do I mean by that? Let's say I am a corn farmer and I see that today the corn is available for a price or can be sold for, let's say, $500. But I do not know when I actually produce the corn at what price will my corn be sold. So I can enter into a contract in the futures market at today's price to sell my corn in the future. So whatever happens in the spot market, it's not going to affect me. If the price of corn drops from 500 to 400, that's absolutely all right. My position is hedged, absolutely hedged. So I'm not bothered. I can go about doing my business by concentrating on what I do best, farming. On the other side, let us say that I am a cornflakes manufacturer. Now I need corn, but I do not need the corn right now. I need the corn throughout the entire year. The corn is available at $500. What if the price of corn increases? I'm not going to keep up. My price of my cornflakes may not be able to be increased, keeping up with the increase in corn prices. So I have an inherent price risk in business. Is there any way to eliminate it? Yes, there is. By hedging my corn needs on the futures market. So now we have two different kinds of participants in the commercial aspect of the COT report. One is the long hedgers. Now, who are the long hedgers? The people who actually, the commercials who actually want to buy the commodity, which in our case are the cornflakes manufacturers. They are the people who will go long in the futures market. And then we have the short hedgers. Who are the short hedgers? The people who have or who are going to have the commodity which is going to be sold. So commercials are divided into long hedgers and short hedgers. And in my opinion, they kind of set the boundaries of where the pricing goes. Now we have the other category called speculators. The small time traders and speculators, they are one and the same. They're not concerned about corn or any other commodity. They want to make money on either rising prices of corn or falling prices on corn. That are the speculative traders in the market. Now, one particular characteristic of the commercial traders. The commercial traders, since they already have the commodity and they are offsetting their price risk by hedging into the market, they might be willing to take a loss. What do I mean by that? Let us say that I am a corn farmer and I expect the current market prices are $500 per unit of corn, and I expect that by the end of the year, when I actually have my corn available, that the prices should become 525. So if that is what my expectations are, I might yet lock in a price of 500. Why would I do that? Because I'm a short of a $500 right now, rather than lock in or not lock in my price and risk that the price might not be 525 or even remain 500, but lower than 450, and I might not even make money enough to offset my operation costs. So that's one particular characteristic of the commercial traders. They are willing to normally go at or lock in their prices even if it is a loss from what their expectations are. That's number one. Number two is that the speculators, they are in it to make money. They are not in it to offset the prices. If speculators expect that the market is going to be 525 by the end of the year, then they buy the corn at, or the futures on the corn market, they buy them at 500 and hope to hold it till it becomes 525. So those are your speculative arrangements in the commodity of commitments of traders market. Now, how do I actually use this? I find that it is a very nice observation when you actually see the different players who come into the market. There are certain prices or certain price levels wherein the long hedgers are very active. Then there are certain price levels where there are short hedgers who are very active. Now I kind of make those my two extreme endpoints, and then I try to trade in the direction of the speculators within those two extreme endpoints. Let me give you an example. Let us say that the corn is currently at 500, but at if it costs $450 to produce corn, and if the price of corn drops to 450, I as a farmer, I'm not going to lock in my price at $450. Why am I not going to do that? Because at that time I can choose not to produce corn at all. If the headache of producing corn is not offset by the price which I'll get for producing the corn, or the profit, why should I go up ahead and do that? So at certain price levels, the short hedgers, their participation in the market changes drastically. Let us say that on the other hand, if as a commercial trader I cannot purchase corn for more than $600. So let us say the pricing of corn is now 610. So as a commercial trader or a commercial long hedger, I'm not going to hedge my prices at 650. Why? Because at that time I can choose not to produce cornflakes at all. Why should I lock in a price which is beyond my own profit dynamics? That's the reason why I like to look at the price levels of the commercials, which kind of give me the border price ranges. And now, how do I attempt to profit from that? I look at to see whether we are at an extreme price range. If we are at an extreme price range, I'll see how the speculators are actually interacting with the commercial traders, whether the speculators are actually going net long or net short, and just watching the entire dynamics, whether the long hedgers are coming in from the commercial end, and who's offsetting the long positions from the commercial end? Is it being offset by the speculative position? Now, all of this I'd be able to explain in detail subsequently, but I wanted to give you an overview of what the commitments of traders report is and how I actually use them. Another technique which I use is I try to use extreme positions for reversal. So if the pricing is between what my commercial long hedgers and my commercial short hedgers dictate it should be, then I'm going to follow the speculators. Why? Because that's what I am also. I'm also speculating in the market to find out where a particular price of commodity or currency might actually go towards. So I'm going to follow the speculators. But if it is at an extreme end of price level, then I might get my reversal hat and not follow the speculators and follow the interaction of the commercials with the speculators. I hope you've learned a little bit about the commitments of traders, and if I get enough of likes on this video, I'm going to start posting every week my net positions on or like a signal service, what I'm actually going to do at what price levels based solely on the commitments of traders report. So if you like what you see and would like to get more, click on the like button. Thank you.
Hey, press.